Hello and welcome to this latest Master Investor podcast. I'm Jonathan Davis, and today I'm very pleased to be joined by Ben Crawford, who is the CEO of an AIM-listed company called CentralNic. Now, you won't possibly tell immediately from the name of the company, unless you are a bit of a techno nerd, I suppose, exactly what it does. So before we start, Ben, I'm going to ask you if you could just give us a little bit of a brief potted history of the company and how long it's been going and how long it's been listed and so on, and how long you've been involved yourself.
Thanks for having me, Jonathan. Yes, the history of CentralNic is very interesting. It started as a UK innovation back in the 1990s as the first network information center, hence CentralNic, Network Information Center, to be privately owned to manage multiple domain names. And so quite a technical and specialist company. I joined it back in January of 2009 after having being involved in two roll-up strategies before that, a New York-based one around the media industry, and prior to that, one based in London around the sports industry, which was funded by Stuart Newton, the well-known fund manager, who was on hiatus after selling his original fund to Mellon Bank. And so when I joined, it was in the midst of the subprime crisis, and the business that I was involved in New York, the media business, we were having to shut down a lot of our operations, but CentralNic was hiring because it had a business model that was incredibly resilient to economic downturns, because the products that it sold were subscription products. They were low-cost products, and they were products needed by every company that wanted to be online. And if you give up using the product they're selling, domain names, it means your email stops working, your website goes down. So it's pretty much the last cost saving that any company makes. And yes, so happily they were hiring, and there was a big opportunity on the horizon, which was the introduction of new top-level domain names. So there had been, back since the 1980s, there'd been .com, .net, .org, and then during the 1980s, each of the countries had got their country code, so .co.uk for the UK, .fr for France, and so on. And this was the first window when new top-level domains were going to be introduced. And so we threw ourselves into it and signed up to be the technical partner of a large number of entrepreneurs. We won 60 contracts to launch new top-level domain names, with the business plan of flooding the market with low cost, high quality domain names to compete with .com and .co.uk and hopefully take a lot of market share from them. And on the back of those 60 contracts that I won, we IPO'd back on AIM in 2013. So we had the technical solution, we had the contracts, we had the dream of disrupting .com and .co.uk and taking over the internet. And so that's how the company started. We got onto AIM. What happened?
So that was back in 2013, I think, and. So at this point, you had still a relatively small business, I imagine, at that stage, certainly compared to now. And it was, it was a very, as you say, a steady business, but it was you were ambitious for growth at that point, but it remained a pretty a low growth business, does it not?
Well, look, when we were private, we dividend out all of our profits every year, and the shareholders would buy new cars, and it was it was a great lifestyle business for the shareholders. But they realized there was something bigger. There's a bigger opportunity, which is why they brought me in, and indeed there's proven to be. As we think, the year we IPO'd, the year before, we had $3 million of revenues, and we're currently on $600 million revenues, roughly, as a run rate. So yeah, we've come a long way, and done that through a combination of organic growth, but also quite a number of acquisitions as well.
So, and
And,
just on one point, personal point, before we go on to talk about that. I mean, I think you're an Australian, I think it's fair to say. And I think and you run this sort of, what is now sort of current company operates in many countries. And I think you're based in the Middle East, are you not? Is that right? According to
I live in Dubai.
in Dubai,
Yeah.
right? Okay. So, and just in terms of yourself, I mean, your background is, I mean, you've been an entrepreneur. Would you describe yourself, or as a
No,
professional manager, business manager, or are you, marketing?
yeah.
Yes. What's your particular
My back,
gig?
sure. So I was a journalist and then moved into management in media. Happily, I was trained in the very hard school of Australian media, dominated by the likes of Rupert Murdoch and Kerry Packer. Yeah, and so after that, when the internet, and so I worked in print, then I worked in satellite television, and then when the internet started, I was fortunate to win some very large contracts. This is back in Australia, first with Microsoft, a multi-million-dollar content contract back in the mid-1990s, and then with IBM to run the content and the marketing for the website for the Sydney Olympic Games. So I was which turned out to be the highest traffic website of the 20th century. Quite a feat then, but obviously I'd say there's many a website today that does that as much traffic as we did in 2 weeks in about 5 minutes. But it was a very exciting time and to pioneer the internet. And it was one of the kind of highest earning websites too, in terms of advertising and e-commerce and ticket sales and so on. So it really threw me in the deep end. And after that, I moved to the UK, continued to work in sports and media. And then, as I mentioned, Stuart Newton acquired our company, Sport Business Group. And I guess it was under his tutelage that I started to learn about mergers and acquisitions and acquiring companies. And then I went and joined Louise McBain, a New York-based entrepreneur who also had built a phenomenal business called Trader.com through acquisitions, and had IPO'd that on NASDAQ. And so again, learnt many tricks of the trade and whatever from another really super accomplished expert in roll-up strategies. But then working in the media in New York and at the time of the subprime crisis was not pretty, and so I moved into this 100% recurring revenue business, which obviously is a great place to be in times of economic uncertainty. And so
just to put a point on this, you've basically been effectively involved in the internet business since almost from the very beginning. In fact, so you've seen the whole journey through the TMT bubble, and then through consolidation, through the arrival of the big platforms and so on, and the astonishing growth of Amazon, Google, and Facebook, and all the rest of them. And you're happily, I guess, a business that is effectively, making money out of the growth of that whole digital economy, and doing it and starting in a very kind of small but sort of pennies in front of a steamroller type business, and growing it through acquisition to something which is much larger today.
Yes, that's exactly right. So today we've ended up, we really have businesses in 2 particular areas. One is around providing the basic tools for companies all over the world to get their own part of the internet. So that's their web address, their website, their email, and so on. Very basic tools, but the great benefit there is, one, it's just driven by the growth of the internet, by companies going online, or these days by digital native companies being created, and all of the products that are sold in order to enable people to get online in that way are subscription products. And so it's a very highly predictable, growing, recurring revenue business. And our model in that is building a marketplace, and that we'll get onto marketplaces later, because the second marketplace we have is our online marketing services. So these are services that either, if once you have your website, if that website's attracting a lot of traffic, so say it's a blog or a video site or a gaming site and so on, we can help you monetize that traffic by placing ads on your site and allowing people, when they've finished reading what they have to read, to click off and go and buy something from someone else. Or if you're on the other side, if you're trying to acquire customers online, either selling online like an e-commerce company, or like the millions of other companies that promote themselves online, be they dentists, doctors, lawyers, roofers, and so on. They're not actually selling online, but they need to use the internet to acquire customers. We offer a suite of tools there too. And we have many competitive advantages in that particular space, but one of the key ones is we're very much platform neutral, which means that we, as the platforms grow, we thrive. So if the traffic's all moving from Facebook to TikTok, great for us, because we can acquire customers on Facebook or TikTok. We're not tied to any particular platform. And so it's proven to be a hugely resilient business model. And again, because whether you're selling traffic or you're acquiring customers, you want a continuous stream of new customers or of revenues. And so because all of our clients are very interested in recurring revenue, the effect is that we get that benefit as well. So we equally have a very attractive recurring revenue model on our online marketing business as well.
Okay, so now you had a very successful year last year. You reported some exceptionally good figures last year in terms of profitability and revenue growth. But I guess there's been we'll talk about that a little bit more, but there's been a step change in the nature of the business, as you've said, since you moved into the marketing area in particular. And I think that's quite a recent development. I think 2019 was when you made your big move into that area. Correct me if I'm wrong about that.
That's correct.
And I guess the question might be, and since then you've added lots more through acquisitions. I suppose the question I might ask you first, or rather tongue in cheek, before we talk about the success, is, well, what took you so long to get into that particular business?
Well, we'd had our eyes on a particular business we really liked for some years, but we're just struggling to get our foot in the door, and eventually we did. It was bad luck for the owners, because they got into some financial distress, and then suddenly they became willing sellers, and we were able to acquire this company, Team Internet, that we'd known for a long time and really sought after. And when that was a real connector for us, because that was a company very, very involved in the domain name and web presence business, but also in the online marketing business. And so that kind of created a bridge for us across into this new area of online marketing. And to explain, like, why is this a much faster growth business? The entire sector is much faster growing. So the web presence of domain names and websites is about a $30-odd billion business, growing at low single-digit percentages a year. The online marketing business is a roughly $450 billion business, growing at north of 20% a year. And so, not surprisingly, the more exposure we have to that, suddenly it changes our organic growth profile. I'd say, it was, there've also been some, I'd say, even some changes in our shareholding since we moved into that, because there obviously were some investors that were very, very wedded to the incredibly predictable but low growth online presence business. But obviously there's a lot more excitement when you can move from sub 5% growth to north of 50% growth organically in the space of 3 years. Clearly there's a lot to get excited about. And the beauty of the business is we have a number of other very investable qualities, obviously the recurring revenues that I mentioned, but also we have cash conversion of only over 100% from our adjusted EBITDA number. and that's true across all of our businesses. And so we're really a cash generating machine, and suddenly generating an awful lot more than we ever did before.
Indeed. I mean, if one looks at some of the numbers, I mean, I'm just looking at some historic figures here. I mean, in 2018, you had a total revenue about $56 million, and last year it was over 400. And I certainly, the forecast I've seen, for this year, have it analysts talking about it going to, 550 or more even this year. So that is strong growth at the top line.
Yep.
And but last year was the first time you made a kind of a serious, big change in your profitability in terms of operating profit anyway. And so why, you've explained part of the reason for this, but why, given the underlying change in the nature of the business towards this more profitable, faster growing area, what was the trigger that's turned you from making small operating losses to operating profits?
Well, I think I mean, it's got a lot just to do with the scale of the business versus the scale of the acquisitions. And so obviously we always focused investors on our adjusted EBITDA number, because clearly we felt that that was a excellent reflection of the true underlying profitability of the business. And indeed, the proof of that was it matched very closely the amount of free cash flow that we generated. The operating profit was often just distorted by amortization, which related to acquisitions. So when you buy a company, you need to allocate the purchase price to various intangible assets, which then need to be depreciated or amortized rather through the balance sheet. And that's and it's an odd quirk of accounting, because you never have to replace those assets with, so there's never any cash that needs to be spent again. It's already been spent in the acquisition. And so we felt that that essentially just distorted the operating profits as were reported. But as we've continue to, but as we've scaled up, then obviously and the acquisitions play a smaller role than the existing operating businesses, then that has allowed the operating profit and to jump up from exactly break even to $10 million. So significant increase.
Indeed it is. So, I mean, I think I guess this partly also speaks to, the awareness of the company and understanding of the company out in the analyst community. You have more analysts covering the company now, and you're engaged in obviously some active marketing to get across this strong message. I mean, I guess there's some investors are put off by, companies are highly acquisitive. There have been some well-known issues with those over the years. But as you say, yours is backed up by significant cash generation, and the nature of the business is very different from some of those acquisition mining companies. So what can we expect looking forward? What can you say about the coming year?
Well, in the past 12 months, we've recorded 53% organic growth. And this is obviously against a background in the last quarter of a huge amount of different factors that have introduced uncertainty into the market around inflation, around the labor market, around unpredictability from central banks, around obviously the war in the Ukraine, and continuing trade wars, and so on. So lots and lots of external factors that could impact on us. But if we could, and as I'm sure we would all love to, move all of those factors aside, we see no reason why that kind of growth, our 50% growth, cannot proceed. And the reason for this is this. We're addressing a $450 billion market, and if we continue to grow at 50% a year, we could reach the year 2030 and still have less than 1% market share. So the opportunity is so huge and growing so fast that that we have an enormous amount of runway ahead of us. Now, that said, obviously, neither we nor anyone else is actually throwing that number out and saying that's the growth we're going to have because of all of these external factors. We need to build that risk in, and we feel like the analysts have done a good job of building that risk into the forecast. But we all hope that none of those factors are going to impact on us or anyone else as badly as some people are predicting. I'd say and there's a couple of other factors here too that are quite important. One is a move to online privacy. So this is obviously changes like GDPR, but also policies coming from Google and Apple that they want to restrict third-party cookies, which means companies collecting private data about individuals and selling it. Happily, our company has never got involved in any of those activities. Our technology is completely different. It uses big data, it uses artificial intelligence, it uses what's called contextual marketing. So what we do is, for an advertiser, someone that wants to sell something online, we don't sell you data of customers. What we do is say, look, as we've placed ads over 100 million websites over more than a decade, we've collected so much data about where to put ads for different products and where it works, that we can predict very accurately where to get the best customers from by placing your ads on the internet. And so this new technology is really falling into a lot of favor these days because essentially because privacy invading alternatives are falling out of favor.
Yeah, that's a very important point. And I think so potentially that is an opportunity for you to gain some market share, presumably, as well as just continue the underlying growth.
Absolutely, and we feel we certainly are. I'd say the other really key point is marketplaces that I mentioned earlier. This has been our model in our first business and is now a model in our second business. And the principle is relatively simple, that if you enter a market and you buy a number of companies and each one of those has different customers and different suppliers, but then you can merge them together, all of the suppliers can sell to all the customers. And if in the middle, you actually have very smart technology, so it's not just an introduction agency, but you're actually adding a lot of value through artificial intelligence, through fraud prevention, and so on, you can actually increase the growth of those businesses to make them higher than any of these individual businesses was able to achieve on its own. We've done that with the online presence business, which is now growing at 9%, much higher than any of the businesses we ever bought. But in the online marketing business, we've done the same thing to obviously enormous effect, where we bought businesses growing at 10% a year and put them together and have something growing at more than 50% a year. But exactly the same principle, but in this case, it's different sources of online traffic. So where people are surfing the internet, exclusive rights to websites, non-exclusive rights to others, our own media buying team, and now our own publications all on the internet. And then on the what's called the demand side, the people that actually write the checks, the advertisers, access to the various different large platforms which the advertisers use to buy ads on, as well as direct to advertising agencies and media buying agencies. And that gives us a large number of alternatives of buyers of traffic. So we can sell the traffic, and essentially where we're getting to is being able to auction the traffic and find, here's a great customer who's willing to pay the most for them. Is it a big online retailer? Is it a big online advertising platform? Or could it be a brand in their own advertising agency? All of whom we are now connecting up in our system. And that's a very significant driver of our organic growth.
Okay, and so how dependent then for the future growth is this company on making further acquisitions? Obviously, you've completed one earlier this year where you were able to do a placing and fund it through equity issuance and also some debt. What should we expect from you in terms of acquisitions? Are you still hungry for more, and do you need more in order to sustain the kind of growth rates that you're now talking about?
Well, the growth rates I've talked about now are the organic growth rates. The inorganics sits on top of that, and look, would it be possible for us to stop acquiring now? Of course, we're not in any way dependent on continued acquisitions to sustain our organic growth, but we'd be fools to, I think, because there's a much greater opportunity to make a more robust business. The more partners you have, the more suppliers and the more customers you have, the more robust your business model is, the less dependent you are on any particular customer or supplier. So I think continuing to make acquisitions makes us a stronger and better company. We're already global in that we have customers in every country in the world where we can legally do business. But there's plenty of opportunities out there to get more critical mass in high growth markets around the world, which we would love to have. I think we've been very clear to investors for many years now that there's a very attractive consolidation play where the value of a consolidated marketplace group compared to individual businesses, which may have some revenue and customer concentration, is vastly more attractive and a better investment. So it's a direction we absolutely intend to continue down. When it comes to financing, we raised money in the week one of the Ukraine invasion. We were oversubscribed. We then went to the debt market as well, which we'd always planned to supplement that. And again, we're oversubscribed there. We have a lot of support, and you can understand why. I think we're still very much undervalued compared to peers listed in the United States in particular. And so those who are familiar with our areas of operation and comparables in other countries can see that we continue to be an excellent investment.
A couple more questions for you, Ben, and then I think we can wrap this up. It's been very interesting. First of all, on the issue of peer groups, I mean, who should one compare you to in terms of global competitors? You say obviously you're a very small share of a very large market.
Indeed.
Who are the peers that you perhaps benchmark yourself against, or even look up to, perhaps?
Well, I mean, obviously we look up to Google. That's our that's our inspiration every day. But look, in terms of listed companies in the domain name space, there are companies like Two Cows on NASDAQ, VeriSign on NASDAQ, and GoDaddy are all great success stories. I'd say Two Cows is suffering a little bit at the moment, but that's because it diversified into particular telco technology domestically within Canada, and so its fortunes are tied to that. On the marketing side, I think particularly interesting is a company called System One, which recently IPO'd on NASDAQ through a SPAC. And there's many similarities between their business and our online marketing business. But I guess so if you said we had Two Cows and System One, and we kind of combined the two together, and both of those parts of the business we could see growing into easily $1 billion revenue businesses in years to come. There's plenty of market there. There's plenty of potential acquisitions there, and certainly there's plenty of blue sky ahead of us.
The final question was just on the balance sheet. You've got some plans to refinance your debt, I think, or you're hoping to refinance some of your debt. And what is your kind of long-term strategy for the balance sheet and for the amount of debt that you have on showing on there?
Well, we raised the debt back in 2019, which was a bad year to be raising equity on AIM as a small cap, because that was the year of the election, of the start of the trade war between the US and China, and of course of Woodford. And so we decided to go to the European debt market and issue a bond in Norway. We were a kind of first-time bond issuer, pretty much unknown in Europe, and yet we were able to raise enough money to do 4 acquisitions that year, which really transformed the company. And we've done a couple of tap issues since then. The current coupon rate is 7%. So each time we did a tap issue, we actually were able to raise a debt at a premium from the par value of the bond, which meant that the effective rate being received by the investors was 4.5%. So that's given us an awful lot of confidence that we can refinance at a lower coupon than we are currently. We peaked at about 2.5 times net debt to EBITDA when we did our last acquisition back in 2019, and have since then, just as we always said we would, have improved our debt position continuously since then, so that our current net debt is below the EBITDA number in the market now for this year. So we've dropped from 2.5 times to below 1 times. We've got $85 million of cash currently in the bank. So, in fact, more, excuse me, not 90.6 million. We feel like very comfortable with our level of debt. When we refinance, we expect to drop the coupon rate, but we understand very clearly that there's a segment of AIM market investors that are uncomfortable with higher net debt to EBITDA ratios. And so, we're very sensitive to them. And if we did have to go up again, we would continue, we would improve our position every day until we came back to the current levels. But with the equity market support, with all the cash on our balance sheet and so on, we're not expecting to have a future spike in debt at this stage.
Okay, so I think that brings us to the end. It's been very interesting talking to you. Fascinating business, and obviously been very successful in the last couple of years. I think your company has been nominated, shortlisted, I should say, for the Small Company Awards, which is a splendid achievement. And you've talked positively about the outlook for this company, the growth outlook. How far do you think you can take this company, and what are the main risks? Is it as you grow, if you continue growing at this pace?
Well, look, I think, as you pointed out, this company has coexisted with some of the most awesome competitors that anyone's ever competed against. We've got Facebook trying to tell people, hey, you don't need your own website, just take a Facebook page. We've got Amazon saying, hey, you don't need your own website, just set up an Amazon store. We've got Apple and Google saying you don't need your own website, use an app. And yet we're growing, and we've continued to grow, and our sector's grown, and we're growing fast. So it would be very hard to imagine companies that are better than the ones I just mentioned emerging out of the woodwork. I think we've really undergone a test of fire year after year and been able to grow through all of that. So, and I think, as you've heard, we're very, very attentive to making a robust business plan where we're able to succeed come what may. We also have a big focus on innovation and staying on top of market trends to ensure that we're never left behind. And I'd say so far so good. We continue to operate in that same vein. So where will that take us? I guess all those companies I mentioned were the size we are once. So I view, I'd say there's plenty of milestones ahead, but I don't see any kind of terminal value or revenues for us.
Well, let's hope that's the case. I'm sure it will be. So thank you very much, Ben, for spending this time with us. It's been very fascinating, and I wish you every success from here.
Thanks very much, Jonathan. Great talking to you.